Gold reached a record $5,594 an ounce in late January. Then the United States and Israel struck Iran. The Strait of Hormuz was disrupted, oil surged, and gold did something that sounds completely backwards. It fell. By June 26th, gold was trading near $4,000, almost 29% below that record. A major war, an energy shock, missiles across the Middle East. This is supposed to be the moment when gold shines. So why did the world's most famous safe haven sink during the crisis it was built for? The simple answer is that war pulled gold in two directions at once. Fear pushed it up. Inflation, interest rate expectations, and a stronger dollar pulled it down. In 2026, the second force became stronger. Let me lay out the timeline, because the shape of it matters. Gold had already spent most of 2025 climbing. It gained more than 60% that year as investors bought gold-backed funds. Central banks added reserves. The dollar weakened, and uncertainty kept rising. By January 29th, 2026, spot gold touched its record just under $5,600 an ounce. Then, on February 28th, the United States and Israel launched strikes against Iran. Iran retaliated. Shipping through the Strait of Hormuz was disrupted, and the oil market suddenly had to price the risk around a route used for roughly 1/5 of global petroleum flows. Gold reacted exactly as you would expect at first. On March 2nd, it jumped more than 2% during the session before giving back some of the gain. Fear money arrived, but did not stay in control. Over the following months, gold moved lower in stages. It fell through important technical levels, suffered its worst weekly drop in decades during March, recovered at times, and then weakened again. By June 24th, spot gold had briefly dropped below $4,000 for the first time since November. 2 days later, it was still hovering close to that level. So you have a record high, then a war, then a long decline through the middle of that war. What was the market seeing that the simple headline missed? A war does not affect gold through one channel. It affects it through at least two, and they can point in opposite directions. The first channel is the familiar one. War creates uncertainty. Investors worry about banks, currencies, trade routes, and political stability. So some money moves into gold. Gold is scarce, globally traded, and nobody else is promised to repay. That is why it is treated as a safe haven. But the second channel begins with oil. When fighting threatens a major energy route, oil and gas prices can jump. Higher energy costs feed into transport, manufacturing, electricity, and food. That pushes inflation higher, or at least makes central banks worry that inflation will stay high. And what does a central bank do when inflation is too high? It keeps interest rates higher or raises them. That matters because gold pays no interest. Imagine two places to park money. One is a gold bar that may rise or fall, but pays you nothing. The other is a short-term dollar asset paying a reliable return. When that dollar return rises, holding gold becomes more expensive in a very specific sense. You're giving up income you could have earned elsewhere. Economists call that opportunity cost. This is the chain that dominated 2026. War threatened oil. Oil lifted inflation fears. Inflation fears pushed markets toward higher-for-longer rates, and then toward possible rate hikes. Higher expected rates strengthened the dollar and raised the cost of holding a non-yielding asset. That pressure outweighed much of the safe haven buying. Now, did one new Federal Reserve chairman cause the whole fall? No. That would be a neat story, but the dates do not work. Kevin Warsh only took office as Fed chair on May 22nd. Gold had already been falling for months under Jerome Powell, as traders reacted to the oil shock, inflation data, and the possibility that the Fed would not cut rates as quickly as expected. Warsh then reinforced the hawkish message at his first meeting as chair in June. The Fed held its policy rate at 3.5% to 3.75% on June 17th. But it said inflation remained elevated, partly because of energy supply shocks, and its new projections showed several officials expecting rates to finish the year above the current midpoint. Markets heard that as a warning. Cuts were no longer the main story. A hike was possible. That changed the comparison facing investors. The dollar climbed to a 13-month high, before easing slightly after the latest inflation report. Gold, priced in dollars, became more expensive for buyers using other currencies. At the same time, dollar assets offered a better yield. That is why the line people repeat, war equals higher gold, failed. The war created fear, yes, but it also made the competing safe asset more rewarding. There's another layer here, because not everyone buying gold is making the same decision. On one side are traders, funds, and exchange-traded funds. This money can move quickly. It reacts to the dollar, bond yields, inflation data, momentum, and the next central bank meeting. When the expected return on cash or bonds rises, some of that money leaves gold. When gold falls below widely watched chart levels, more selling can follow simply because traders are protecting themselves from a deeper decline. On the other side are central banks. They are not asking what earns the most next month. They're asking how to diversify national reserves over years or decades. Central banks bought about 244 tons of gold in the first quarter of 2026. But one detail in the earlier research needs correcting. China was not the largest reported buyer that quarter. Poland and Uzbekistan led the disclosed purchases. The wider point still holds. Official institutions continued buying even while prices were volatile. Why would they do that? Partly diversification, partly distrust. The dollar remains the world's dominant reserve currency, but dollar assets exist inside a financial system influenced by the United States. After Russia's foreign reserves were immobilized following its invasion of Ukraine, more governments had a concrete reminder that reserve assets can also carry political risk. Physical gold held at home is harder for another country to freeze. Does that mean central bank buying creates an unbreakable floor under gold? No, a floor is too strong a word. Central banks can slow their purchases, some can sell, and private investors still move the price every day. But persistent official demand can cushion weakness and support the longer-term case, even while faster money is leaving. That gives you the real split. Short-term swings are often driven by rates, the dollar, and investor positioning. Longer-term support comes from diversification, reserve demand, and the belief that gold still matters in a fragmented financial world. So who won during this fall? The clearest winner was the dollar. It benefited from higher expected U.S. rates, resilient American growth, and heavy capital flows into U.S. assets. Central banks that wanted more gold also gained a chance to add it at prices well below January's peak, although calling that automatically profitable would go too far. Their time horizon is measured in years, not weeks. The obvious losers were late buyers who treated the January rally and the war headlines as proof that gold could only move higher. They did not misunderstand the existence of geopolitical risk. They misunderstood which part of that risk the market would price most aggressively. And was the war premium a bluff? Not really. The conflict was real. The disruption to Hormuz was real. Oil did surge. The mistake was assuming that every consequence of war would help gold. Some consequences supported it. Others hurt it more. That distinction matters far beyond one metal. Markets do not react to whether an event sounds scary. They react to the chain of consequences that follows. A missile strike can lift gold through fear. The same strike can lift oil, push inflation higher, strengthen the dollar, and raise bond yields. If the second chain is stronger, gold can fall while the war gets worse. In fact, that happened repeatedly in 2026. Gold sometimes rose when peace talks improved because lower oil reduced inflation fears. It sometimes fell when fighting intensified because traders expected tighter monetary policy. That is the part that looks upside down until you follow the whole chain. And a global effect does not stop at gold. A stronger dollar makes dollar debts harder to service and imported fuel more expensive for countries with weaker currencies. The same move that pressures gold can squeeze governments, companies, and households across emerging markets. So this is not just a story about people trading bars and coins. It is a story about how one war can rearrange the price of money around the world. What happens next? Start with the uneasy US-Iran truce. A preliminary agreement announced in mid-June helped reopen Hormuz and pushed oil back toward pre-war levels. But the agreement is not a final peace settlement. and the attack on a cargo ship near Oman on June 25th showed how fragile the route remains. If tanker traffic continues recovering and oil stays lower, headline inflation pressure should ease. That would reduce the urgency for rate hikes, weaken some of the dollar's advantage, and remove part of the weight on gold. Notice the irony. Less geopolitical fear could actually help gold if peace lowers oil and changes the interest rate outlook. But if the truce breaks and Hormuz is disrupted again, the first reaction may still be safe haven buying. What happens after that depends on oil. A brief scare with limited energy damage could lift gold. A long disruption that sends inflation expectations sharply higher could revive the same rate and dollar pressure that hurt gold this spring. Then there is the Federal Reserve. Current market probabilities can change in a single day, so I would not build the whole story around one percentage. The broader point is enough. Markets still see a meaningful chance of at least one rate increase before the end of 2026, while the Fed itself is focused on inflation staying above its 2% goal. My view is gold remains volatile and capped in the near term while the dollar is strong and rate hike risk is alive. But I do not think the longer-term gold story has disappeared. Central bank demand, fiscal worries, and reserve diversification are still there. Even J.P. Morgan's current outlook, after the fall, points toward roughly $5,000 by year-end, with $6,000 presented as a longer-term possibility rather than a guaranteed 2026 average. The signal to watch is not simply whether another missile is launched. Watch the combination of oil, inflation expectations, U.S. yields, and the dollar. If oil stays lower and the Fed's language softens, the pressure on gold changes. If energy rises again and the Fed becomes more hawkish, the lid stays on. Here is what I actually think. Gold did not fail in 2026. The slogan failed. People want gold to be a panic button. Frightening event happens, gold rises, end of story. But gold is not reacting to fear in isolation. It is competing with interest-bearing assets, moving against the dollar, absorbing investor flows, and serving as a reserve asset for governments. In this episode, the paying alternative one. That does not mean war is now permanently bad for gold, and it does not mean interest rates explain every move. It means the direction of the price depends on which consequence of the crisis becomes dominant. Fear can help gold. Inflation and a stronger dollar can hurt it. 2026 was the year the second force won. So that is the strange truth. Gold fell almost 29% during a major Middle East war, not because the danger was imaginary, but because the danger changed inflation and interest rate expectations in a way that mattered even more. Do you think this is only a temporary pause in gold's rise, or has the market changed more deeply? Drop your view in the comments. I read them. If this made the gold puzzle clearer, please like, share, and subscribe. See you in the next video.